Hi, everyone. This is Ian Ippolito. Before we get started here, I'm going to read a few things. So just a reminder to everyone that everything here is highly confidential. Do not share anything here outside the club. If you do, you will be ejected and legal action will be pursued against you per your NDA. So I don't receive money from any sponsors or platforms for anything. And you can read the list there. For clarity, I do receive compensation if members make donations or if there is a feeder. This is not investment, legal, or tax advice. We are just investors expressing our opinion, not licensed financial advisors, not attorneys, not accountants. Always consult with your own licensed professional before making any investment decision. All information provided is personal opinion only and does not constitute professional, financial, tax, legal, or other advice. It may contain errors, so use at your own risk. So I'm going to stop my share here. And I am going to turn this over to Tanya Krug at Pelorus. Hi, Tanya. How are you doing?
Good, how are you?
I'm doing good.
All right, everybody. We have Rob Seacrest, the president of Pelorus, and he's going to go through a video and kind of high level of Pelorus. We really encourage everybody to ask any questions through the chat to all panelists. Make sure it's to all panelists. I will be reading them live at the end and asking Rob at the end. We also have Travis Goad, head of underwriting, with us as well, and he will be able to answer some questions as well. All right. I'm gonna
You
hand
know
it
what,
over to
Tanya? Before we do that, I think I saw Travis log in, but I do not see him as a panelist now.
I
So,
think he's under Rob and he's on
oh,
mute.
good,
I
great,
think so.
great, perfect.
Travis,
I'll
do you
read.
want to just?
No,
Okay.
great,
Hi, Travis.
awesome.
Perfect.
Okay.
Thank you.
All right. Okay. Well, thank you, Ian, for putting this together. And, we've been talking with your group for quite some time, and we really appreciate the Ippolito group. So what I thought I would start off with today is it seems that that the visuals help in this industry because the asset class that we're lending on is so different than a traditional asset class. So I'm going to start off with just a brief short video for 2 minutes, and then we'll go through our deck. I'm going to go through it a little bit quickly. This is the deck that you'll be provided after this webinar, and you can take more time through it, but I really want to have this be more of a dynamic environment where you can ask questions that I didn't cover in going over the pitch deck. So hold on a second. Give me a minute here, and we're one of the first cannabis-focused debt funds out there, and now we're probably the first mortgage REIT that's specifically non-plant touching. There's a couple of other REITs that are traditional REITs that own properties and do sales leasebacks, but we've been at this a long time. We've done over 5,000 loans and $1 billion in origination between myself and the other two principals over our careers. And so we bring a lot of expertise in doing value-add lending. With cannabis properties, the tenant improvements are so massive because the amount of revenue that the tenant produces is orders of magnitude higher than a traditional non-cannabis tenant. And so those tenant improvements to facilitate that, when you go into these facilities, look like a lab. In fact, you're wearing lab jackets and glasses and all that stuff. And it looks like a full-blown lab, except the things they're working on are plants and the extraction of those plants and everything else. What Pelorus does is we've utilized our expertise in designing loan structures that are mitigating the risk when we do a loan in a secondary market. Both of those transactions, both the T-Boys and the Tikkun Olam, and all of our transactions, it's all about how we structure the deal. So almost every one of our transactions has a large budget component plus personal and corporate guarantees. I think that for you to invest with us is that you know what our proven track record is. We've done 32 transactions for $65 million. We have perfect performance. We're probably more time in the industry than virtually any other lender that we know of. But most importantly, we're not trying to make any money off of our investors. we're not taking a big asset management fee, we're not taking a carried interest split, and we're sharing income from our side of what the borrowers are paying us. So what I would say back to you is, why wouldn't you? Show me another fund that is no cost fund that's producing these type of yields.
Okay, so let me just stop that video for a second. And okay, make sure it doesn't autoplay. Yeah, okay. All right, so let's see here, and I'm going to go back to turn this stuff on. All right, now go. Okay, so again, thanks for joining us here today. We're going to be talking about Pelorus and the Pelorus Fund. Pelorus is an asset-based lender that provides secured term loans through a private mortgage REIT to a special class of property owners with cannabis use tenants who cannot obtain traditional real estate loans due to the dislocation of the capital markets caused by the federal regulations. We understand the rare alignment of these opportunities unfolding in the cannabis real estate market, and we built our team to capitalize on this opportunity. We actually recently increased our fund offering from 100 million to 250 million earlier this year, based on the increased demand that we continue to get since the inception in 2018. We are able to offer a competitive competitive asset management fee of 1% and have achieved consistently high returns because of our revenue alignment between the manager and the fund members with our unique fund structure, whereby the manager shares fees paid by the borrower with the fund members. And I'll get into more of that in detail as we move along. Our target yield is 15% IRR. We make monthly distributions, and I'll touch on some of these other things here. So, the reason that we converted to a private mortgage REIT earlier this year is that mortgage funds and trustee investments are effectively taxed at ordinary income, and that is as a heavy hit for people that are investing in this asset class. So normally a fund would not convert to a private mortgage REIT until they typically have 50 million or more assets under management. We actually did it with substantially less than that at the time. And the reason that we were able to do it is that most real estate funds have a 6 to 8% yield that's coming out. And so the advantage isn't significant enough to warrant the costs. For us, our yield is so high that it had an immediate positive benefit, even after you netted out the one-time costs and the compliance costs and move forward. There were some additional advantages by converting to that structure as well. One is that we're a national lender, and at a certain point, we're going to surpass the income that we can generate in various states, and we would have had to file tax returns in up to 33 states across the nation. We're currently in 5 right now, but we plan to be in potentially all of those states that are medically licensed, and so that would have forced our investors to have to file tax returns in those states as well. And so we wanted to get in front of that issue. So by converting to the REIT, you get the 20% federal tax deduction off the top. So in our circumstance, that's 3 points off the top, if that's what the yield is for the year, which we've been achieving. Additionally, you are only paying taxes in the state that you are domiciled. So not only do you not have to file taxes in other states, but you get the tax advantage if you happen to be in a low tax state or no tax state, such as Florida, Texas, Nevada, Alaska, South Dakota, those other states. That's a massive advantage as well. So we made those changes. And there was one other one that was significant, is that the REIT structure cleanses the possibility of UBTI. So we don't utilize leverage. However, we will have a warehouse line at some point, and that would potentially trigger that as well. Our fund has a target yield of 15% IRR. We make monthly distributions. We're diversified over, we currently now have, we've done 37 transactions for 84 million. Is the total amount that we've done since we've entered the asset class. The fund currently touches, I think, 21 of those transactions. I already covered this other stuff. The fund was established in 2018 and converted to a mortgage REIT earlier this year. And the benefit of the fund is that we've aligned our interest with the members by sharing revenue from the manager side. And again, I'll get into more of that in a little bit details later. Something that was unique, we had prognosticated that our asset class would do better in a down real estate cycle or a down economy, but we had not forecasted how we would do through COVID. I don't think anybody had stress tested that one to the extent that it happened. And what was unique about COVID for us is that our portfolio and all of our borrowers went through that unscathed. And it really shifted the position from investors that had traditionally said, you guys are lending to a specific asset class. I'm not sure how I feel about that. I'm just not quite there. We had this massive shift in April. Over 100 investors have come in so far since that time. And all of a sudden they realized that they had too much exposure into non-cannabis transactions and that they wanted to diversify themselves into this asset class, which one had a significantly higher yield, significantly less loan to value, higher creditworthiness sponsors in most cases. And the loan to value, we had no leverage on the yields that we're getting. So that really shifted for us a lot. And that was partly from the benefit that cannabis was deemed an essential business through COVID-19. So where that mattered is that all the top to bottom operations, from dispensaries all the way down to the cultivators, were able to continue to operate. They all did still have to work through family issues of kids and daycare and childcare and things like that, and reorganize things. So it wasn't that it didn't hit, they still had to deal with things, but the businesses were allowed to operate. They repositioned and everybody went through it without any issues. Also, what was unique about the cannabis sector is usually you're going to traditionally use commercial distribution lines and other back-end services that might have been impacted. Well, cannabis, everything has to be licensed. So just distribution and all those things were still considered essential businesses. So the entire sector went through completely unscathed from the COVID aspect. There was some spikes in the cannabis consumption on the retail level, but that dropped the next month. It was just people hoarding. Everything is continuing on track with the cannabis consumption market and steadily increasing across the country. So I'll move on here. I think I just want to give a little bit of background about Pelorus and kind of how we got here. So between myself and the other partners, we've originated more than 5,000 transactions and over $1 billion. That's over 30 years of experience that our CEO has been doing this, and our combined team. We just recently have added Travis. I don't even know how many. Travis is a young guy, but I think he's been doing it for a while too. I don't know what the total is, but it's probably close to 100 years of collective experience between everybody. So Pelorus we did non-cannabis transactions before. Our specialty is value add transactions, and when we refer to value add, what we mean by that is a portion of the borrower's loan is being held back in a budget, and that budget is going back into the property to enhance the value of that property, whether it's through ground up construction, fix and flip, or stabilization of the tenant improvements, whatever it might be. So we've refined that process over thousands and thousands of loans and several real estate cycles. That process is a complicated process. Nobody likes to do value add loans. Everybody likes to do just an acquisition refinance because you don't have to do anything post closing. On a value add transaction, after you close, you still have to keep working on it. We process usually up in somewhere between 50 and 100 draws per transaction after we close. Every one of those draws has to have lien releases for every single invoice, proof of payment, matching to the subcontractor and the contractors and the insurance and the lien releases all the way down the line. It is a massive process to go through. We've refined that process, and we've gotten that process down to 1 to 3 days, and I'll talk a little bit about that more later. But we were in the traditional non-cannabis space, and we were getting our investors low double digits, 11, 12% at about 65% average loan to values. Well, around 2014, those yields started compressing down to, they went all the way down to about 6 to 8%. But more importantly, the loan to value started going up from 65, 70, 75%, even 80% and 90% on purchases. We've seen this story before. The quality of the sponsor did not improve to justify that, and we basically left the space. And we had been watching the cannabis sector, and I'll go into a little bit more detail about what changed it for us there a little bit later. But we had been watching the sector, and by 2016 we originated our first transaction, and then in 2018 we launched the fund, and then in 2020 we created we converted to a private mortgage REIT. I want to just talk a little bit about the fund structure, because not only do we lend on a unique asset class, the structure of the fund is, in our opinion, unique or not common in this particular asset class. So we designed the fund as what we call a no-cost fund. You can't actually have a no-cost fund, because at some point you're going to let the assets pay off. You need to collect those payments and disperse those payments to the investors and service that portfolio of loans. So you have to have some ability to manage the operations with no income coming in at all. And so what we did is a 1% asset management fee, which is more than sufficient to do that. And then in addition to that, the manager shares originations fees with the members. So we've aligned the manager's income with the members' income. And how we've done that is that typically we charge the borrower 4 points and 15% note rate. So of those 4 points, we share 25%, or 1 point. That 1 point goes to offsetting that asset management fee. In addition to that, we share post-closing fees as well. The most common one would be an extension fee. When it comes to an extension fee, we flip-flop it, because we've already done the majority of the work. Now we're just re-verifying that everything is in compliance to extend that loan, whether it's for a month or 3 months or 6 months. And now we share 75% of that extension fee with the members. And typically the extension fees on an annualized basis are at least equal to what the origination is, and usually significantly higher. So we might be giving 1 month extensions for 1 point each time. So the fund would get 75% of that 1 point, but on an annualized basis, that would have been 12 points for that. So you can see that it's pretty profitable center for fees. In addition to that, another thing that's important is that we have no preferred, no pref to the investor. So there's no 6% or 8% pref, and then an 80-20 split with us getting 20% carried interest. For our fund structure, we are not trying to make any money off our investors. We're just utilizing this silo of capital to further accelerate the capacity for us to close more loans and become the leader, maintain being the leader in the space. So for us, what we did is, because there's no carried interest split to our side, we decided to give 100% of all net income to the fund members. So 100% of all net income is going to the fund. So there's no pref at 6 and then a carried interest split after that. It's just 100% of all net income. There's one other thing that I want to mention. We didn't foresee this. We think that we're smart, but we're not that brilliant. We didn't foresee in the cannabis sector that we would be able to have warrants in the tenants down the line, but we did have the foresight to include in the fund structure that if there was some profitability event that occurred, that would be shared 50-50. Well, as of today, we have at least 1 transaction where we have warrants in the tenant, and I'll get more into that later. And we have a couple of more transactions that are going through underwriting that we've been able to get warrants as well. So why this is important is that not only do we have the security of the real estate, personal and corporate guarantees, but in addition to that, you have cannabis equity funds that are making equity investments into these the cannabis operators, which would be our tenants. And those guys are the effectively, loss leader. It's equity. Now we're getting just the upside for that. We didn't give up anything. We're not changing any of our underwriting protocol whatsoever. It's just that our loans are in such high demand and the benefit is so massive for the tenants, for them not to have to use the cash on their balance sheet to improve an asset that they don't even own, that they're more than willing to give up shares to facilitate and make that loan happen for them. So I'll get more into that in a little bit later. And this is just showing some growth. We do reinvestment or cash distribution. By changing to the monthly distribution, now if you're reinvesting, you're going to get compounded 12 times a year. Previously, we were doing quarterly distributions, and we've enhanced that. I want to just quickly give a high-level overview of 3 sample transactions that the fund did. One is Candescent. That transaction was a yield of 14.5% or note rate, 18-month term. The loan amount was $4.5 million. It was an acquisition and tenant improvement loan. We did it at 39% loan to value. The budget on that property was $4.5 million. We did not get any warrants on that transaction. That transaction, I'll give you a little bit of details on the specific one. That particular transaction was in Desert Hot Springs. Desert Hot Springs is a secondary market, and all lenders and investors are concerned about secondary markets, and especially a specialty asset class. And they had been searching for a loan. First of all, Candescent is a high-end luxury brand. They already had 2 facilities in Desert Hot Springs, and they were just expanding their operations. Very well-known player. They had $32 million in the bank at the time. The CEO is a guy from Harvard that's already had multiple successful exits. And they were shopping around for the best rate out there, and everybody that they would go and get a term sheet from, they went to loan docs 5 times, and none of the lenders could close. Well, we came in and we said, look, we're actually, the purchase price on this, by the way, was $4.5 million, and the tenant improvement budget was $4.5 million, so $9 million in cost. We said that we'll actually give you a $4.5 million. So in one aspect, 100% loan to purchase, which is crazy, but we made them come in with $4.5 million to close. So effectively, we had a $4.5 million loan recorded on the property, and they paid for their own property. And so when you look at it from that perspective, our loan, we have not dispersed any money out on whatsoever, and they've already bought their property effectively free and clear. And we're just telling them, look, we're going to continue to improve your property and add value to it for the term of your loan. After we close this transaction, I always laugh because one of our investors that we work with is a San Diego billionaire. And he's like, I had looked at that deal so many times, and I just couldn't get comfortable. If I would have known that you could do it that way, I would have done the deal. We're like, well, that's why we are leading the space, is that it's how you look at the deal. You can't just say a secondary market, oh, I don't want to hear about it. You got to look at how that deal was structured. So anyway, on that particular transaction, we processed 90 draws over a 12-month period. It took them 12 months to do the tenant improvements. It was a 27,000 square foot single-story building. And that facility does $1.3 million a month in revenue. On that facility, over those 90 draws, we probably saved them 1 to 2 or 3 days at least by processing those draws as quickly as we do. And if you just count 1 day of saving for all 90 draws, that's 3 months. We basically enabled them to generate an additional $3.9 million. If they do $1.3 million a month, if we could get that facility up and stabilized 3 months earlier, they were able to generate $3.9 million earlier and penetrate the market sooner. When you look at the cost of our loan, we were arguing over $180,000 of combined points and interest over the time that the term of the loan. It's insignificant compared to the amount of revenue. And so that's what people have to understand. This asset class, you have to people understand real estate. People have been investing in real estate, but this is a whole different game. This is a whole different amount of revenue that's coming through this. It's a whole different level of amount of money that's being put into properties to improve them. You need to think of these properties as a laboratory environment. In fact, one of the facilities we showed you was built for Pfizer. So these facilities are being built at that level, even though that it's for a plant. So don't discount that it's just a plant. That's a high revenue plant. Okay. So I'm going to talk a little bit about a couple more of these transactions. We did another transaction in Michigan, Grow Packers, 15% note rate, 18-month term, $4 million loan on that. It was not in Wisconsin, sorry. This was out in Desert Hot Springs as well. This was an acquisition ground up with tenant improvements. This is one of my favorite transactions. This particular transaction is actually the largest beverage bottler in the entire nation for cannabis-infused hot and cold beverages. They also have the FDA level of facility for the food, for hot and cold THC-infused food as well. So this facility is a co-packer. Everybody needs a co-packer for all the beverages and the edibles that are being created with THC across and each one has to stay within its own state. You can't cross state lines. So this facility was built for its ultra high capacity. And in this particular transaction, we were able to scrape warrants, and we've scraped multiple warrants. And in fact, I'll touch a little bit on this later with Travis. Travis we enhanced our warrants and on the last warrants that we scraped, and I'll go into that in a little bit later. Rubicon was a transaction out in the state of Michigan on 8 Mile. This was a 327,000 square foot shuttered strip mall. The borrower had put it under contract prior to the state being approved for recreational. At the time, it was just medical. He also put the property under contract where the subject property was not in a green zone and it was not approved for cannabis. And so he entered a co-development agreement with the seller. And that agreement allowed the buyer to have the option to purchase conditional upon him getting it approved for cannabis. Well, not only did he get it approved for cannabis, he got 224,000 square feet of it approved, and the state happened to go recreational. The property became a flagship of value out in that state. The borrower told us he had an offer to buy his property the day after we closed for $35 million, and he turned it down. That property, we just did the acquisition. We needed to make sure that our borrower could count on us, that we could close, and that the myriad of backup offers, that property did not go to some of the backup offers and him lose his earnest money deposit and things like that. So that's why it's so important in this industry. We've developed a brand name out in the industry, in the cannabis borrowers is a small community. They trust us to close, and they're willing to pay a premium to know that they've got a lender that can close. I'm going to get into a little bit about the how Travis enhanced our warrants for us. We had basically previously just had the warrants where actually our loan could be paid off and our warrants would still remain out there. On this particular transaction was for a term of up to 6 years. And you know, if a liquidity event came, then we might, if we're in the money, we might be able to have an upside. Well, Travis looked at this and he said, guys, you're leaving something on the table. We can tie that liquidity event to the payoff of our loan and simply just add that what that warrant cost would be that a liquidity event is to the payoff demand of our loan. I'm trying to make this as simple as I possibly can because it gets high level, but basically in the scenario that we're talking right here, this loan will be an $8 million loan. The payoff for that loan would be $8 million. The payoff demand would have the warrants at a discount, if we did it this way, added to the payoff of $831,000. So when we got paid off, not only would we get our principal back, but we would actually be exercising a lender put on this particular structure and capturing another $831,000, which increased our yield on this transaction from 15% note rate to about 22%. So That's normally how we would go on all transactions, is to take our cash off the table and just continue to be conservative as we move along. The alternative would be if the company was public and we're in the time period of not being able to sell, we would probably go ahead and execute that. This is, by the way, at the lender's sole discretion at which way we decide to execute and add to the loan balance or to continue on and hold our warrants for the term. I want to just briefly talk about the orders of magnitude difference between a cannabis property and a non-cannabis property. This happens to be the numbers from the Desert Hot Springs transaction Candescent that I previously mentioned. That facility is a 27,000 square foot facility. The property value, if it was non-cannabis, on the super discounted value would be at least $2 million, probably higher than that, but I want to just show the worst case scenario. Tenant improvements on a non-cannabis property, if any, maybe a couple $100,000, and the monthly revenue, and this was borne out by market comps of that particular appraisal, is maybe $100,000 of revenue, and the lease rate might be $20,000 for that particular property. Now, compare that same property that happens to be in the green zone, which, by the way, all cannabis properties must be in a designated area called a green zone. And then in addition to that, just because you're in that zone doesn't mean that you're eligible for cannabis. You must have a conditional use permit specifically for that property that's tied to that property. By the way, that conditional use permit transfers through the sale of the property and through foreclosure. And this particular property, when they acquired it, already was in the green zone and had the conditional use permit. So there's a huge premium to be paid for that, to have those things in place already. That property was purchased for $4.5 million. Tenant improvements for $4.5 million, $9 million in total cost. Their monthly revenue, $1.3 million. That's actually up to $1.9 million today. They've been able to enhance the efficiencies from the facility. They're pumping in more CO2 into the rooms to extract higher levels of THC out of the crops, and the market's on fire as well. That monthly lease rate on that property, that's an owner user, $65,000. So just again, to recover on what qualifies for a cannabis property, it must be in the green zone. There are green zones established in each one of the communities that have approved or gone pro-cannabis in each municipality. The property must have a conditional use permit for the use of cannabis. By the way, the tenants also must have a cannabis operator permit. That's issued by the state. But you have to tie the two together. So even though, for example, California is an unlimited cannabis operator licensed state, that doesn't mean that there's unlimited license. Each one of those licenses has to be boarded into a specific municipality, and they have to approve it going into a property. So it's not truly unlimited from the sense. Another thing I want to talk about is how it's legal and safe and how that's happening. So first of all, we only lend in the states. There's 33 currently that are medically licensed. So the states, you've got clearance in that state to not be prosecuted by the state this is for the cannabis operators, which aren't even our borrowers. So we're not touching any cannabis related business directly at all. But on top of that, more importantly for us was to make sure that our tenants didn't have the ability to be prosecuted by an aggressive executive branch or administration or the Department of Justice that had changed from pro-cannabis to against it. And actually that did happen with Sessions coming in. And so back in 2014, Dana Rohrabacher and Blumenauer put together a standalone amendment that used the power of the purse from Congress and defunded the Department of Justice from prosecuting any cannabis-related business in a medically licensed state. That was originally passed in 2014. It's a standalone amendment. It has been reapproved every single year with overwhelming bipartisan support. And in this most recent year, in the $3 trillion relief bill, that standalone amendment was moved into the omnibus spending bill. So thus, every time that the federal budget is passed, this is now passed along with it, or if there's a continuing resolution. So why that's so important is that it doesn't matter what the feds want to do or not want to do. Congress has taken away the money to prosecute that. Now, if you were an illegal operator, the Fed and the states can still prosecute you, but we would not lend to, we maintain that and verify the licenses when we originate, and we continue to verify that along the path of the loan as well. Our loan is secured by the commercial real estate and SPVs that are bankruptcy remote that own the property. So our borrowers are independent of ever lending or touching anything directly cannabis related. In the case of Candescent, where it's an owner user, it is a separate entity that is the holding entity that owns that property. So it is still technically and legally remote. So we've got, I don't know, 15, 18 episodes of, on our YouTube channel of facility tours. This is actually inside of Candescent, one of the 5 grow rooms inside. And you can go through and get a visual of this stuff. We realized as we were educating investors that me telling the story wasn't really the same as them seeing it. And even in person was the most important, because the sense of smell is overwhelming. And when you first walk into the facility, you gotta start adjusting your senses and your mind to what this facility is. And by the time you walk out, not only do you you're desensitized to the smell of the cannabis, but you realize this is a real business. These guys have really made this a commercial business. This is the real deal. And part of that process really happens when you're at these in person. So we did our best to film many of our facilities and put those on videos for people to see. So one of the advantages of why people are utilizing us in over all that time of doing 5,000 loans is we've really refined the process of value add loans. And it's exacerbated by this specific industry, with the tenant improvements being such a huge amount of money per property, anywhere from $150 to $250 a square foot just for the tenant improvements. But it's compounded by the fact that the tenants' income in those facilities are orders of magnitude higher than a traditional non-cannabis tenant. So you really need to get the facility completed as quickly as possible, because there's no revenue being generated there yet. So you want to get that generating as quickly as possible. So most other private lenders are typically doing draws in 5, 10 business days, somewhere in there. And banks are doing them in 2 to 4 weeks. If you're processing, 50 to 100 draws, you do the math and figure out how long it's going to take you to get that facility done. Typically, you don't do as many draws because you're bulking them up into the next time that they're going to approve that. But if you run out of cash to be able to advance for those contractors, they're going to stop working until that next draw period comes by. And so we've realized in doing all these loans that even if you've got a balance sheet like Candescent, $32 million, you don't want to utilize all that money to advance for contractors when you could be using that for working cash flow to grow your business. So we realized that the faster that we can provide the disbursement for the draws, that was the key to the business. And that was the key to the business in fix and flips, ground up construction, because every month that was going by was clicking off at, 1% more loss in profit of that transaction. Eventually, if you go far enough out, you've lost all the profit because you took too long getting the property completed. So we realized that a long time ago, and we've just brought that process, and it really played into the sector. All right, so, our loans are high performance capital. As in the examples I've given you before, when your tenants are doing millions of dollars a month, the disparity of the cost of our loans compared to our competitors' loans, it's insignificant when you look at how much quicker we're getting those draws processed and getting those facilities stabilized. But more importantly, we have the name to close, and people aren't willing to risk trying out another lender to see if it works. I'm just going to give a couple of keys, fund terms here. It's a 506C. We're targeted to raise $250 million for accredited investors. We've reduced our minimum for the Ippolito group to $50,000. Our targeted yield is 15% IRR. We did 15.5 last year. We ended last quarter at 20.9% IRR. We're on track for hitting 15%, no problem this year. We do monthly distributions. We do allow reinvestment option. You can also change that at any time. We're not anticipating bringing on leverage to enhance the yield of the fund like traditional real estate, but we will have a warehouse line of credit. We're desperately working on it. The banks just don't want to give it up yet. They're not very profitable, but we're working on that. The term of the fund is evergreen. The lockup period is 1 year. And after the 1 year is over, you can withdraw 25% of your principal per quarter. We actually give 1/12 of your principal, 1/12 each month, so you can count on some cash flow. And if we can accelerate that, we will. Our management fee is 1%. Our hurdle, there is none. Carried interest split is none. The manager is Pelorus Management Group. Our bank is First Federal Bank of Florida, which is an FDIC insured, cannabis-friendly bank. They bank not only us, a tier 2 ancillary cannabis business, but they also bank tier 1 direct cannabis operators, such as Candescent, and they're actually a direct cannabis lender. There's actually 8 FDIC insured banks that are lending directly to cannabis operators and 1 publicly traded. And there's probably, dozens and dozens of, we've identified at least 4 dozen state credit unions that are lending directly. So the misnomer that that this is a total cash business and that there's no banks and there's no lending is untrue. We can attest to that with our own bank. Our legal counsel for is Grassi Law Firm. They've been in the hard money industry and funds for a long, long time. We've been with them for 20 years. Our auditor is Armanino. Armanino not only is our auditor, but they also do our taxes and our REIT compliance for us. Here's some of the team members here. We've also got many more people than this. Travis Goad, who's on the call, has recently joined us from Harbor Group International. And he can tell you a little bit about himself when he comes on a little bit later. We also have Tanya Krug, Investor Relations, to help support my side of the company. So Dan and Travis work on originations and our underwriting. And then Tanya and I work on the fund and raising capital and the fund management. And then Rick is working on, he works on the entitlements and the real estate acquisitions of the company and making sure that everything is on track on that side. We are watching, and the Pelorus has other avenues of business that we do. We don't just do the Pelorus Fund. We originate other transactions. We have other sources of revenue. We own cannabis properties ourselves. We're in the business, and we think that's the best approach, is to have multiple types of revenue coming in at all times. We also have operations department, processing department, and then we third-partied off the fund control department to the largest fund controller in the nation, who most of the banks use, which is ProBuild, owned by Dixie Line Lumber. So why invest with us now? There's no competition for us right now. That's not going to be the same. Eventually, our peers are going to come into this space and compress the yields. But we know what our yields are going to be for at least the next 18 months. We're setting that now with the loan terms. And by the way, our average note rate is over 15%. In addition to that, we're going to be able to scrape more warrants in these next several quarters. And as more competition comes in, those will disappear. The sales of cannabis continues to increase as more states come online. It's an industry that's been there. It's not that it's just newly created. It's just moving from the illegal market to the legal market. We've got a massive portfolio. We typically have more than 150 million. It's actually more than that are deals that are ones that we would be willing to do. I'll show you a portfolio in a minute of about 115 that we're trying to get closed in the next 60 to 90 days. And then, as I mentioned, we're scraping warrants, which is just an upside that traditional lenders, you would never be able to get that. And that's a unique opportunity from this particular business. We have about 50, I don't know, it might be up to 100 now, frequently asked questions that we keep for everybody. We've aggregated those through all the conversations that we've had that we will provide to you. And now I'll go ahead and open it up for questions. Just so you know, you can reach out to us directly by emailing investorrelations with an S at pelorsfund.com. that goes to both Tanya and I, and we can provide you information. We can provide to you the most recent pitch deck, the summary of our distributions, and anything else you want. You can request access to our due diligence data room and things like that. That includes our audits for the fund and things like that. So Tanya, if you want to let me know what questions, and I'll answer those, and then maybe we can introduce Travis as well.
Of course. A lot of these questions have been answered in the pitch deck, but I'm going to re-go over them in case somebody missed it, just to be fair to all the questions that are being asked. Okay. So do the principals or key employees have prior experience with lending to cannabis or medical cannabis businesses prior to 2018? If not, what kind of complementary skill set do they have?
Yeah.
Excuse me.
We've been lending for 30 years. It's just a different use tenant. And yes, we started lending before the fund in 2016 in the sector. So we started that sector in 2016 before we started the fund.
Okay. What do you see the possible risks being mid and long term? And are you, your partners, family, friends adding more money into the investment into the fund?
Sure. So we've got over $1 million ourselves combined between the fund and the manager. Most of our money is in the manager because that's where the growth needs to be accelerated there. It's more efficient use of our capital, and we would be the loss leader in that side. Regarding the biggest risk, I think that most private money funds and people that are in the non-cannabis sector, I think a lot of them are struggling and looking for some alternatives to having to compete against thousands of lenders for the same deal out there. And so the biggest risk is that we're going to get compression from our competitors. And so that's going to push the yields down, and eventually the LTVs are going to start going back up. And so when that starts to occur, if it gets to where we're uncomfortable or gets outside of our credit box, we'll leave the space and just let our loans pay off. And that could be from a number of different factors. The sector could become federally legalized, and everybody goes into the sector, including our peers that can do the same type of lending that we do. And there's some good competitors out there that could move into the space. And if it comes down too much, we'll just let our loans pay off and we'll return the capital. I can assure you, we've been ahead of the curve on back in 2009. We had the first fix and flip no cash product back then for experienced operators that we had teamed up with a hedge fund, that we went to 50% LTV, and the hedge fund provided the balance of equity that was necessary. We were very successful with that product. We had another product that we rolled out in 2014 that took us to $100 million of private placements that we were doing. So we are always being nimble and looking out what's coming up. And we've got some things that we're already looking at as things shift around here in the cannabis sector. So we'll let the portfolio pay off if that becomes the case, but we'll always have something to offer our investors if they want to opt to reinvest with us and go another direction. But I think we've got a good, easily 3 to 5 years, even with competition, because even as the yields start to compress, and that's fine. We modeled our fund yield at 15% at a 12% note rate, so we're actually much higher than that. But that higher yield, the higher yield over the note rate doesn't kick in until you start harvesting those extension fees. And so we haven't started harvesting a lot of those extension fees yet. And so why I mention that is even in the next 18 months, we know what our fixed note rate is over 15%. But as we go past that period, if we start harvesting those extensions or those warrants, it'll bring up our aggregate yield for the year to continue to keep us in that 15%. And I suspect it'll compress down to 13 or 12 over time, but I still think it'll be a better asset class than other ones at the time. And if it's something that's not attractive, then we'll let it wind down and let everything pay off.
Okay. Do investors have any other risks or liabilities for anything other than the money they invested? I think
no.
Yeah. Okay. I just wanted you to answer that. What type of tenant do you see as a replacement if cannabis tenant goes away?
Yeah, that's a really broad question. If it's in a urban market, it would look at who the tenants are at our neighbors and what we're doing or what's happening there in that particular time. what's hot at that time, or if it's a secondary market. So the advantage that we have that a lot of people forget is that we're the lender. We are the senior lender on these properties. So in the event that the tenant failed, obviously the highest and best use is cannabis, and we replace that tenant with another cannabis use tenant. If for some reason that property became ineligible for cannabis use, that's the only time we wouldn't be able to reboard a cannabis tenant. And in that particular circumstance, if that happened somehow during the period of our loan term and we didn't see it coming somehow, remember during that period of that loan, 18-month term, even though we might be doing a $5 million loan, we're holding back, you know, as much as $4 million of that. So if we see an issue, we're going to quit dispersing money and we'll do a principal reduction with the remaining balance of our loan, so we can minimize that risk in the short bridge that we have. We believe that the guys that are doing, our peers are doing transactions for 3 to 5 years. We believe that that's where you have more of a concern about losing, seeing a compression in lease rates from other cannabis tenants or additional green zones being created. So we don't see that as necessarily a worry within our loan, but as being the senior lender in the transaction, if we did foreclose and if we could not reboard a cannabis use tenant, we have the ability to easily bring in a tenant with enhancing that with tenant improvements for that new tenant. And so normally owners of the properties are not as able to do that, and we are. We would be able to factor that in, get a new tenant into that property, do the lease improvements that make sense for what they're doing, organic vegetables or whatever it might be, or a indoor cooled storage facility for medical products or whatever it might be. We're able to make those improvements to the property so it makes it easier for that tenant to be boarded. Once we get that tenant boarded and that income coming back in on that property, now we can look at how long will it take for us to bring in money on that property to either one, sell it at a profit with that tenant on board, or at least bring down our basis low enough or close enough to what our par basis is to sell that asset so it's not at a loss.
Okay. Is the fund IRA UBIT friendly?
Yeah, that was covered. It is self-directed IRA. We have a list of pre-approved ones. Pensacola just recently approved us, which they had not up until Tanya discovered it earlier this year. So that's massive. There's been a massive shift in I wouldn't call them necessarily an institution, but I think they're owned by Lincoln Financial, and Pensacola was recently sold to Premier Trust Bank, I think, which is owned by Lincoln Financial. So a lot more institutions are getting more comfortable with cannabis. So we have a list of self-directed that we can provide to you, or you could let us know who you're with and we'll let you know. So we do allow that, yes.
Okay. As part of the due diligence, will Pelorus share the loan book info? I'm assuming maybe they mean our cannabis portfolio.
Yeah.
And
so
the answer is yes. We would do that.
We do provide quarterly updates, and I believe that they've been shared in the group. So you get monthly statements and quarterly updates, which include the portfolio of the loan tape.
Okay. Somebody would like you to talk in detail about the risks from the federal government.
Yeah, so I think I covered that already with the Robacher-Blumenauer amendment. And again, we're not lending to anybody in the cannabis sector. So we're actually remote from it. But the reason that we are paying attention to it, we don't want our tenants to be prosecuted by the federal government, and thus that have to replace that tenant unexpectedly. Okay.
There's a couple of tax questions, your favorite. You have a tax opinion that the 199A is available to investors despite 280E.
Yeah, you've got two things conflicted here. 280E applies to cannabis businesses. We do not, we're a lender. So we are not a direct investor in a cannabis business. So that you've got two buckets of money confused. So we are purely a mortgage REIT. We are not an owner of a cannabis business. We do not have any ownership in them. We don't have any issues with 280E.
Okay. And a few people are wondering if we issue 1099s or K1s.
Sure.
What is a K1?
Yeah, so our structure of our fund is the Pelorus fund issues K1s. The Pelorus fund wholly owns a sub-REIT. The sub-REIT actually issues a 1099 to the fund, and then the fund issues K1s to all the members.
Okay. Somebody's asking, would Pelorus consider a feeder fund to enable a lower minimum investment?
Yes, so I'm happy to talk about that. We actually have several feeder funds. We have one from a cannabis equity fund that created it for international investors. We're not able to board international investors. So we're happy to have give you the short path for that. You typically need $5 million of aggregate of money for that feeder fund to work, and that would probably be under a Reg A. Happy to give you the quick and dirty on that if they want to reach out independently.
Okay. And somebody asked directly about that K1s, any depreciation, which there's not since there's dividends. I just wanted you to go over and explain.
So,
a lot of people hear the word REIT and they think that we're a traditional REIT. So can you just go over that one more time?
So
thank you.
Most REITs are associated with a traditional REIT where they own the properties, and they are kicking out a dividend, but they also have depreciation because they own the real estate. We just have the REIT nomenclature. We're a lender, so we just get the tax benefits. We don't own any properties. If we had foreclosed on one, then there would be the possibility of some short-term depreciation, but that's not our model, and we don't plan on owning any properties.
Okay. Somebody asked if there's any bankruptcies, lawsuits filed by or against principals, key employees.
No.
What's the process of capping redemptions?
What's the process of capping redemptions? So
I think they mean, oh, sorry, go ahead.
Yeah, I think so. It's defined in the PPM. So we can do, I think it's limited in the PPM to $1 million per investor per year, or 20% of the fund's assets. We've got more cash flow than most equity funds out there. We've not only have the cash flow coming in, but we also have loan payoffs coming in. So the cap is set in the PPM. Off the top of my head, I think it's 20%, but we have to look at how that's all working. Currently, I think we've only had three redemptions. We were able to get them immediately on a scheduled payment plan, so they knew when they were getting their money. Two of them actually stopped the redemptions and decided they wanted to stay in. And the other one was just doing a small reallocation, and that one I think it was completed already.
Okay. Let's see. Can you provide some details as to one of your loans that currently in bankruptcy, as mentioned in your Q2 quarterly update? How did that situation come about, and what steps did Pelorus take to ensure an optimal outcome for investors?
Sure. So that transaction was back when the fund had a fairly small amount of assets under management, about $6 million. And the fund has the ability to do cannabis and non-cannabis transactions. That particular transaction was a first lien on a hospital complex property that was originated. It was about a $6.7 million loan at 15% loan to value. It had a hedge fund as the junior lender behind us. And the bank that was closing that transaction was short to close several $1 million. They couldn't wire in time to meet the closing deadline, and the borrower was going to lose the transaction. There would have been a lawsuit towards that lender. We made the lender step in and become our beneficiary. This is a bank that came in and became our investor with us. We filled the balance of it. We became the lender of record. So it was originated at 15% loan to value. We charged 35% yield. And the thinking at the time was that we didn't want our investors in the fund to think that we were giving that we weren't giving the fund access to a transaction that was unbelievable yield. And so the fund did a $500,000 allocation on it. It was a 90-day bridge loan. That transaction later got more complicated. The vice president's brother, Joe Biden, appointed himself as the CEO of our borrower. And then he went and put a second lien on our property to pull his house out of foreclosure in South Florida, and was extracting money illegally. The FBI raided him, and the property was put into bankruptcy, and we put an immediate foreclosure on that property. Again, we were at 15% loan to value. It was a very long, protracted court case and bankruptcy. We have settled that, and got not only all of our principal, but all of our accrued interest. And we'll see what happens with Joe Biden. But it was a big issue it was a big issue locally. I'm surprised it never made national press, but you can look up some of that stuff. So from our perspective, we were very well collateralized. We didn't lose any funds on that transaction. We have since then said, people now would say, we don't want you being anything. So we're at this time not going to originate any more non-cannabis transactions. In fact, we're closing one on Monday for $4 million. That is a phenomenal transaction for 15% yield with a guy worth $143 million. It's non-cannabis, and we elected to not do that in the fund, which the fund had the capacity to do it, no problem. But we're going to stay in the cannabis lane exclusively for now.
Okay. Is there a deadline for contribution to invest, or is it on a rolling basis whenever the investor has money to invest?
It's on a rolling basis. We unfortunately, because we don't have a warehouse line of credit, and we don't drag our yield down for our current members, we only admit members when we're closing a new transaction, and we admit the members in the order received. Just to give you an idea, we're sitting on a couple of $1 million ready to be admitted for a closing that's going to happen next week. We've got another couple $1 million that is ready to come in immediately after that. So what's happening is some people say, hey, we just wire, because it's not interest bearing until we close. We close typically every 2 to 3 weeks. We say, look, we'll request your funds, but we're going to admit the money that we have first. And so what's going to happen here is all those people that are requested to wire their funds, they're not going to get admitted because we have 2 payoffs coming in, the AmeriCorps transaction and another transaction paying off. So you keep getting pushed off. So if you want to wait until that timing works out for us to request your funds, great. But we admit the money in order that it was received, in the order that it was cashed or received into our account. So typically that's going about 2 to 3 weeks of non-interest bearing while we admit that. We're admitting usually at least once a month. In the next month or two, I think that we will have a warehouse line of credit that'll make it more regular, and we'll probably say whatever money's here at the end of the month, we'll admit on the first of the month or something like that each month.
Are all your terms 18 months the maximum loan period?
No, that's where we feel comfortable. If it's a fully stabilized transaction with a publicly traded company in a urban market and something, there's a possibility we would do something different, but that's about where the average of the portfolio. It's actually less than that. The weighted average, I think, is 16% or 16 months.
Okay, yeah, 16%. Okay.
Questions, because I do want to introduce Travis for a minute, and I wanted to see if there's any questions specific to the warrant. So can you skim the questions real quick and let us know if you've got any on those? And then we'll maybe Travis could give just a little bit of his background about him, and then answer the question.
Yeah, there's no more questions or warrants. We just got one. What's the incentive for tenants to be paying so much on debt instruments? Is it that they have the difficulty qualifying for traditional loans? So this person, I can just respond to him.
Yeah. Okay, yeah, we covered that.
Yeah.
So
yeah, and like he wants to. Yeah, there's no. So yeah, if you just want to introduce Travis.
Yeah. So Travis, do you mind coming on for just a second and just give a little bit of your background, and maybe you could just share the story of when you looked at rewriting the warrant package for us on Grow Packers, how you realized that there was a way that with your skill set that you could enhance those, and maybe you could turn on your video if you could too.
Sure. Nice to meet everyone. So to give you a quick background, my background and how, of course, I've 13 years of experience in real estate credit markets. When I finished grad school in December '06, one of my first jobs was an acquisition analyst for a multifamily owner and operator. We were partnering with Lehman Brothers and the Carlyle Group, and my job quickly, when '08 happened, turned from finding new deals to how do we deal with the current portfolio. And I was hired by one of the world's largest special servicers, who's a big investor in CMBS B pieces. And there I did a lot of distressed loan workouts on their behalf through last crisis, resolved a little over $2 billion in distressed debt. I was hired out of there to go work for a hedge fund in New York. It was a $4 billion hedge fund where we were investors in both CMBS bonds, the most junior credit sensitive part of those CMBS structures, as well as buying and originating mezz loans, and generally investing in real estate credit. There I also traded a derivative index called CMBX, which is backed by CMBS pools. I subsequently went and started a special situations investing group in Harbor Group International, is where I came across Rob, where we were focused on both the distressed retail sector and cannabis, and was some of the early investors in some of the REITs that were, the private REITs that were doing sale leaseback transactions. One of the things that I did or had the idea to do here at Pelorus was how do we create a liquidity event for these warrants? I mean, warrants have real value, and most of these companies that are the tenants were investing fairly early in their life cycle. So they're typically privately held companies as of today, and there's not a lot of liquidity in their shares yet. Now, obviously, what we hope is that they all continue to grow and hit their growth targets, and they ultimately list to become public, and there is the opportunity for those large upswings in the warrant value. But in most cases, over our lifetime, over our loan period, that may not occur. And so rather than having these illiquid warrants that just hang out there for 5 to 6 years, which may or may not ultimately be in the money and be something that generates significant return to investors, we're able to tie that to the loan balance and create a put option for the lender. So basically at loan maturity, we can make the decision, do we have the tenant buy back those warrants from us as part of the loan balance because it's part of the loan balance, and the new lender comes in and funds some of that buyback? Or do we want to stay along for the ride because we think there'd be a near-term liquidity event and the upside's greater, so it's at our option? And it has the effect of really adding about 500 to 700 basis points of yield on each asset. So that's what we did to do, and it's generating higher yields for our investors.
Awesome. Well, if anybody has any questions on that, it took me a while to understand all the intricacies, so I tried to dumb it down for myself in the deck. But we're grateful to have Travis. We've been working with Travis for a long time prior to him joining our team, and we're excited to have him help enhance in many different ways how the underwriting and origination side of the company is looking at transactions. So. Okay, well, Ian, I think that we're good. We have, we're more than happy to answer additional questions and get more into specifics. People can request access to the data room, and we have the audits in there. We have a letter of explanation regarding Dan for his personal BK that he had previously, and we have all kinds of information in there as well. We also have, if there's a list of attendees that you can provide to us or something, we have an email that has the summary of the fund distribution history, which was 16.54 for last month, as well as the investor deck and access to the YouTube videos and all those things in a previous recorded webinar.
Great, Rob. Yep, really appreciate it. Really appreciate it from you too, Tanya. A lot of good information there. I'm not sure if I'll have to see if I maybe Zoom will provide me with that. Actually, no, I don't think so, because people don't register necessarily for this when they get in. So I don't think I necessarily have a list, but any information that you want to pass on to us, we basically have this thread that's dedicated to you guys. And so, you know, as you have updates and stuff like that, it gets updated in there. So feel free to pass it on, and we will pass it on too as well.
Yeah. And if anybody wants to email us, they can email us directly at investorrelations@pelorus.com.
Great. Thank you very much. We appreciate it.
All
Thank
right.
you guys.
Be well.
Yep.
Okay.
Yep, you're welcome. Have a good one.
Thanks,
Bye-bye
Ian.
now.
You too. Bye.